Certainly thinking about homeownership is a big event. It's scary. And I applaud you for coming this evening. Maybe for some of you, maybe it's a first step. For others, it might be one of several steps, but certainly we welcome you here. I'm Jonathan. I'm a housing counselor with the Mon Valley Initiative. We have two locations, one in um, Homestead, where I'm sitting at right this moment, right here on 8th Avenue. And we have another one, another office in Charleroi, PA. And we, I have the best job here at Mon Valley Initiative, uh, where I talk with people, express interest in learning about homeownership. So my slides in order here. And yeah, so I meet people who want to learn about homeownership, and it's that simple. And I meet people, at any stage. You don't have to be ready. You could be thinking about it down the road. So I meet people at all different steps along the way. Um, my background is in mortgage lending. I worked for several banks over the course of my career, and I've been here at Mon Valley. It's coming up on 11 years, which is hard for me to believe. It's been such a great run here at Mon Valley Initiative, and I think we do some great things. We have a workforce division that helps people with employment questions and issues and resumes, stuff like that. We have some people that do remodeling. We're remodeling a church right behind the Braddock Library, turning it into apartments. Should be coming up for residents availability maybe in the fall or spring. And then we have our apartments. We have apartments that we rent across the Mon Valley, and we own Clareton Inn Apartments in Clareton. If you happen to know Clareton at all, it's one of our big projects that we did in the past couple of years. So we do several things in and around the valley. Tonight, of course, I want to talk about home ownership, and um, I think it's easy. I hate to say that. I think it's easy to buy a home, but it does take work. It takes effort and knowledge, and applying that knowledge on a day-to-day kind of process. So, first thing I think you got to do is set the goal, clearly. So this slide should say, goal setting. A goal without a deadline is a fantasy. So if you said I just want to buy a house, that's a great idea, but it's more a fantasy, a wish kind of thing. A goal with a deadline. So if you said, I want to improve my credit by the end of the year, that's an objective. So you've stated a goal and you've selected a timeline that you want to do that. So that makes it a little bit better goal. You get a goal with a deadline and then a plan. So you want to be a homeowner by spring of next year, and you talk to someone like myself, and we put a plan in place. We've kind of identified what we need to work on and some of the steps along the way, and that becomes a much stronger goal. Um, a goal with a deadline, a plan, and consistent action. And that's the part I don't get to help you with, and is the consistent action piece. I don't get to balance your checkbook. I don't get to pay your bills. That's something that we want you to do. We want you to learn how to do that and get those skills to make your goal a success. And then a personal, meaningful goal. So you want to buy a home because you want your children to live in a place that you own. To me, that's a very meaningful goal. And you add those with a specific time, a plan, and consistent action, and you'll reach the fulfillment of what your plans are. So keep that in mind as we go here. That I gave this presentation last year. I gave it 2 years. I'm going to give it next year. And the great thing is that it pretty much is the same, right? Nothing has changed in lending. They haven't really changed the rules at all. The basic principles are there, and they're going to be there in the years coming. So, we know that what a lender is looking for in order to give a home loan. Unless you're going to pay cash, then I assume that you have to get a home loan somewhere. But the rules are pretty clear, and they're stated, and they're known, and they're going to be steady for us, I think, going into the future. So let's look at some of those. And kind of give you an idea, a little bit behind the scenes kind of look. So the first thing a lender wants to do is make sure that the house that you want to buy is worth what you're paying for it. So this is down the road. This is towards the end of the process. So you sign a sales agreement, you come up with an agreement with the seller on what you want to buy the house for. I would encourage you then to do a home inspection. So you pay a independent person some money, it's upwards of $700 at this time. They're going to take a look at the house mechanically and make sure that the major systems and give you a report based on some of those systems, maybe recommendations of things that are deficient, and give you a plan for maybe maintenance that might be coming up in the future. Once you kind of clear that step, then you're going to give your lender, $500 to $700 for an appraisal. So this is a person that's going to put a value to the property you're buying. So the appraiser has your sales agreement. They know what you paid for the property, and they have a process of comparing the home you're buying with other homes in the area that have sold recently, and they come up with a value. The appraisal process it's one of those areas that's kind of the weak link. It's an opinion based on, I guess, fact. Two appraisers could look at a home very differently and give it different value, and both could tell a judge, in a court of law, why they came up with that value. So for the most part, it's not something I worry about. It's not something I want you to worry about until we get the report back. And then when we get the report back, then we'll take action at that time. So collateral is the first piece. So want to have that in mind. But that's kind of at the end. That's after you've signed a sales agreement, after you've been pre-approved, after you've kind of identified a lender. Got this little slide. I hope that's showing up there. But I thought that was kind of funny. If you owned a home, you would view your house like the one there in the top left. You think it's a cute two-car garage, pretty sizable home. To someone that wants to buy your home, they want to dumb it down. They want to say that it's cute, but it's not as cute as maybe you think it is. The bank, the lender, they usually come in a little bit lower than that. The insurance adjuster, he thinks your house is not worth anything. He thinks it's a little tent, but the people that tax you, they're the ones that see it as a mansion. So that is just something I found amusing. Different points of view for your property as you go through this. Second thing that I think about, and usually the first obstacle that I talk about my clients with is credit. We need to have credit in order to buy a home. There's some certain benchmarks that I share with you if you would want to come over and talk with us. But you definitely need credit. Lender's going to pull a credit report. Most credit reports we see are not like Credit Karma. Many people say, well, my Credit Karma score says this. And the score that I'm pulling is saying that, and people have trouble understanding that. So just know that it's not always the same. They're different scoring models. The credit score you get if you applied for a credit card might be a different scoring model than you would get if you applied for a car loan. And the one you apply for a mortgage would be yet a different credit scoring model. So they're not all the same. It can become a kind of a sticking point. It's hard for people to wrap their heads around, but not all credit scoring models are the same. So what I coach people to do is, I'd like to see you have 3 or 4 accounts, 3 or 4 credit accounts. So whether that's credit card, car loan, student loan, installment loan, I want to see people have a base of credit. That's a good way to do it. It's got to be open. So ones that you've closed, ones that you've paid off, ones that are inactive, that's no longer contributing to your credit score. Ideally, they'd be more than a year old. So new credit, anytime we open new credit, it pulls down our credit score. And then over the course of 12 months, making successful payments, whether it's a credit card or a car loan, then at that 13th month, we really see a bump. We really see a jump in credit score. If you've made it through that first year, that's kind of like the riskiest year. And after that, then it really gives you kind of a positive jolt to your credit score. And then mortgage loans, open up with a credit score of about 620. So that's kind of where I see and what I've seen across the industry, as far as the opening point for you to be able to get into home ownership. So, we keep those scores in mind. So when we think about, making that goal setting, that goal setting might be, hey, I want to have a 620 credit score by September. So keep that in mind. So that's kind of the first goal. It gets you into being able to get into home ownership. All right, next slide here. Um, I want to kind of do what I think strong versus weak when it comes to credit. Strong to me is having a broad base of accounts. So having 3 or 4 accounts that are open, that are more than 12 months old, that you've shown successful on-time payments. And low credit usage. So, for some of you, credit scores, when you fill up those credit cards, when you start getting to the maximum that you can charge, that's going to push your credit score down lower. So we know that. So, sometimes the plans that we make with people is, hey, we need to pay down these credit cards, and there's some certain benchmarks that we talk about in order to try to get our credit score to go higher. On that weak side of credit, what I'd like to try to avoid is self-reported utilities. I know for a lot of people, they're like, I want to self-report my utilities. I'm not sure. Over the past few years, I'm still not sure that those have any significant value to helping your credit score. I don't think it hurts, but I don't know that it really helps it dramatically. New credit. So, we talked about having some time with credit. So having a bunch of new credit, that's not going to help you. Occasional late payments, if you're thinking about home ownership, I'd like to think that you're not having occasional late payments. I'd like to think that your financial stuff's kind of worked out and that you got that kind of behind you. Credit cards maxed out. We talked that lowers your credit score. So yeah, that would be something that we'd want to. Doesn't mean you can't get a home loan that way, but it does tend to push down your credit score. Having only credit cards in that base of accounts that you have, that's kind of on the weaker side. Again, I'm not opposed to you having 3 or 4 credit cards. If that's all you have, I'm not opposed to it. But installment loans help bring credit score up a little bit higher, a little bit faster. And then Affirm and Klarna and Afterpay, I'm seeing this more and more. When I see that on someone, I kind of get the inkling maybe they can't get credit. Maybe their credit cards are maxed out and they're leaning on that Affirm, Klarna, or Afterpay. I'm not a fan of any of them. I think they kind of take away your monthly cash flow from you. And I don't think that they add anything to your credit score. Quite to the contrary, it can actually probably take away if things aren't handled well. I wanted to point this out. This is my Amazon credit card that I have with Chase, and this was my December statement. And I was super proud on this account that I didn't pay any interest over the course of 2024. So I was pretty happy with that. Now, that's not all my credit cards. Don't get the wrong idea. I have some credit cards that I carry balances on. I'm working on it. I'm trying to make them go away. But my Amazon card, I've managed to make it through a full 12 months without giving the bank any money. And I think banks have enough money that I don't want to contribute to them having any more. So let's try to be free of paying them interest, and be free of making them rich, and we're going to try to make ourselves rich. So definitely when I talk with my clients, we talk about credit building. I'm not a credit counselor. I won't set up payment arrangements for you. I won't make payments on your behalf. I won't do any of those things. I'm a housing counselor, and part of the criteria that we follow is that we don't actively get involved with sorting out your credit. That's for you to do, and we can provide some support, we can provide some information, but I can't really take an active role in that. But it's pretty simple. It's 2 things you got to do. You got to clear out the old, and we've got to add in the new. So we got to have that base of creditors. So if you have a credit report that has 3 collections, And one open loan that's good, I look at that as three negatives against one positive. So, in that arrangement, it's hard to imagine that your credit score could go higher. You've got three bad things holding down one good thing. So what we want to do is reduce the negatives and increase the positives. So if we could just flip that around and maybe have one negative and three positives, then that's a framework I can picture some increasing score as time goes on. So clearing credit to me is fairly straightforward. You got to get rid of the bad. You got to get some new good or existing good, and make sure that we're following some of those simple ratios that we have when we're trying to clear credit. Next rule that a lender is going to look at is what's called capacity, or what can you afford. Everyone's different. We can all afford something different based on what we earn. That's kind of the starting point. What you earn sets the stage for what you can afford. What's your monthly debt? So that's part of the equation. Any lender is going to pull a credit report and use those monthly payments that are listed on the credit report for your monthly debt. So you might have a credit card where it pulls up that $25 is your monthly payment, and maybe you pay $75. They're not going to put 75, they're going to put 25. So they're going to use what shows on the credit report as your monthly debt. It kind of automatically feeds into the computer system. It feeds, straight from the credit agency right into the bank's computer, and kind of fills in those balances and fills in those monthly payments. Next part of that equation is what's your anticipated home payment. So the home that you're buying, the home that you bought to pay the have a sales agreement on, what's the anticipated payment that you're going to have on that. And then ratios, this is what they think you can afford for monthly debt. So 29 represents your mortgage payment. So 29% of your gross monthly income. So if your gross monthly income is $1,000 a month, $290 is the limit for someone to have a mortgage payment, a whole house payment, and $410, $1,000 gross income, $410 would be your new home payment, plus any debts that might show on the credit report. So just take that and expand that. So if you make 5,000, then now we're talking about 1,500 front ratio and maybe a $2,000 back ratio. So we'll look at that when you come over and when we talk about what you want to focus on as you're working towards home ownership. So we got the collateral, which is the appraisal. We got the credit, which is the credit score, and quite simply, then we have the capacity. So what can you afford based on what you earn? Sometimes, we get to the part where we say, well, maybe we need to earn a little more because we're not able to afford what we want. This slide, I've had this slide in here for the past few years. I got this back in 2022. In 2022, there was 2021 was a pretty big refinance boom that was going on. And I wanted to point out, and I still think this is relevant today, every day for lenders, and what happens, just natural, what happens with businesses. Banks are part of that. So, lenders with limited staff, are more likely to prioritize high credit quality loans. They're easier to process. So what I thought that would do is maybe give people some insight, or maybe a little peek behind the corner, behind the curtain, I beg your pardon, that, the higher quality we can get, the easier it is, the more likely that someone will pick up our loan and make it work. If it's bad credit, if it's hoppy job history, if it's low appraisal, those are tough, right? And people don't want to work on tough things. They want to work on easy things. So, the motivation I use on this is, well, let's try to make it easier, right? Let's make our credit score the best we can make it. Let's make our debt as low as possible. Let's do what we can do within what we have to do the best we can to make it the best chance that we're gonna make it through this process. So. Financial institutions and organizations, the next highlighted part. So we're an organization, MBI is an organization that support homeowners, can help them improve credit, right? So that's what we're about. That's what I want to show people is, hey, here's how we can improve credit. Here's what we can do with debt and help people have a higher chance, a higher success rate of being new homeowners. And we'd love to chance to do that. So on the capacity side, that strong week, steady work, having steady employment to your history is what they're looking for. Now you can have job changes. I'm okay with that, provided there's positive reason for change, because you want to work closer to your home, that they have better benefits, that they have 401k, that they give you a great pay raise. Those are all good reasons to change jobs. And I would certainly want you to take advantage of those. What's strong in capacity is debt and balance, that you're not overextended. You're not overextended, your car is not a $1,000 car payment. That's what it makes you strong. Having a plan in place. So, you having an idea or a map of how you want to improve things, that you don't have to be there today, but maybe a plan for improvement. Um, thinking about buying a home for months. Sometimes I talk to someone who says, I've been thinking about this for years. Well, good. Then you've obviously had time to put a plan in place and to work on these things. And I think that creates a strong loan application. Rent similar to mortgage payments. So if your rent is $1,000 and your mortgage payment's going to be $1,100, I think that's strong. That's something you're prepared for. You're prepped for that kind of monthly outflow. And I think that makes you a strong applicant. The weak side, if your rent's 500 and you're trying to get a $1,500 mortgage payment, that's a big change, right? That $1,000 increase, it can be a lot for people to overcome when they get into that home ownership. So on the weak side, history of job hopping. You're not able to hold a job. Maybe home ownership's just not ready for you, or you're not ready for home ownership. Let's work on stability, finding where your best talents are, and how to stay with your employer there. Payments on the higher end, just winging it. People who just, I just pay whatever I pay and it's good. This is the one that scares me, is like when I meet someone and say, oh, I want to buy a home next weekend, right? That's they don't have a plan in place. They just show up and this is what I want. So those are difficult. Those are tougher. They're expecting something that sometimes takes a little bit of planning. And then this last one is just based on two cases I've heard in the past 30 days, where someone was, in both cases, they were buying homes, and the homeowner's insurance, they lowered the coverage, homeowner's insurance, in order to fit into that 41% ratio. Their mortgage payment, if they had the insurance coverage that they wanted, was going to be over that number and not make them be able to qualify for a home. So they lowered the coverage in order to buy the home, with the intent or thought that once they're in there, they'll go back and increase the coverage, get the coverage that they really wanted, but that would have a higher payment. That kind of juggling, to me, is concerning, right? If we're tinkering with those numbers just to make you qualify, I just worry about, that's kind of pushing the envelope. So again, here's another slide I got way back in 2022. Again, to just show or share, financial institutions were most likely to deny Black applicants because of inadequate or poor credit history. So if you're Black, let's look at credit extra hard. Let's make sure that it's adequate and it's good, because that was the main reason, or most likely reason, that applications were denied. So, knowing that, we can turn that into action or power or plan to make sure that doesn't happen to us. The second thing was, low and moderate income applicants were denied because they had too much debt compared to their income. So if you're low or moderate income, then let's keep that in mind, and let's plan to to make sure that our debt is in line with what we want to do with buying a home. The more modest your income, of course, the less debt, unfortunately, you get to carry. People that make $10,000 a month, I can't relate to that, but those people, their 41% is much higher than my 41%. So, but we keep those in mind just to fuel, just to educate, just to say, hey, this is me. This person looks like me. This person earns like me, and these are the things that they run into. So I want to make sure that I've got that. I'm ready for that. I'm ready to attack that. So like those things just to give us some real life examples of what happens. The last thing a lender's looking for is cash. You got to have money to buy a home. It's expensive. It's about 10% of the purchase price. So if you were buying a home that was $150,000, then I say we need to be prepared to answer a question of about $15,000. So the great news is that doesn't have to all come from you. You don't have to have all that money, but we do need to have an idea of where it's coming from. We need to know where that money is coming from. So that money is for down payment. So that's the required down payment for the program you're applying for. That can be 0% down. That could be 3 or 5 or 10, 20% down. But there's going to be a down payment. The closing costs are going to be the legal expenses that you face when you buy a home. And those can vary a little bit based on sales price. They can vary based on where you're buying a home. A home in the city of Pittsburgh has a higher transfer tax than a home outside of the city of Pittsburgh. So it's more expensive to buy a home in the city of Pittsburgh just simply because our transfer tax is so much higher there. So that affects our cash, that affects our cost into buying a home. And then the last thing you're going to need money for is an escrow. So an escrow is just a fancy French word for savings account. And that's a savings account to pay your taxes, your real estate taxes, and to pay your insurances, namely your homeowner's insurance, your State Farm or Nationwide. So we need to be able to put some money in there up front so that when those bills come due, that we're prepared and ready to pay those. So that's kind of where your money goes is the down payment, closing costs, and into a savings account. So where can that cash come from? Well, it can come from come from savings. That's to me that's pretty strong. It can come from the seller. Different programs. We'll look at some different programs that allow the seller to pick up some of those closing costs. There's grants out there. There's some programs available. Some through banks, some through other agencies that have money. They can be some of the answer to that 10%. You can get a gift. So if you have a relative or family member that wants to provide you with cash because they always had the dream of you owning a home, that can certainly be an avenue into paying your cash. A loan against an asset. So you can, let's for instance say you own a car that's free and clear. You can use your car as collateral. You can borrow against your car. You now have a car payment. Now you have a monthly car payment, and that needs to be factored in there. But that cash that comes out of that asset can be used to help buy a home. Or you could sell an asset. So maybe you have a snowmobile and you don't want to use your snowmobile anymore. Well, there's a process in order to sell your snowmobile to raise some funds to get you into home ownership. All these things, we have to, the bank, the lender needs to document, they need to show or prove that you have those funds. And some people are like, well, I got money in under my bed. And that's great for that, but it's hard for a banker to understand that and work with that. So we talk about that and the process that goes involved when you want to do that. But different things for cash that it takes to buy a home. Back to my strong week, having a steady and growing savings account balance, that's strong to me. That's someone that's planning to buy a home. And every month I look at their bank statement and there's more money in savings and there's more money in savings. And there's more money in savings. It's growing. To me, that's a strong buyer that's ready to take on home ownership. Where the funds are at. So I know I want to sell that snowmobile. I know it's in my 401k. I know my grandma's going to give me that money, right? Knowing that I think is certainly a strong way to go into buying a home. This is one as I'm looking at people and their cash flow, this is one that's beginning to stand out. No spend days. Can you go a day without spending money? I see so many bank statements where there are multiple, basically debit, right? Everyone buys off their debit card, but multiple purchases on any given day. Usually Mondays are the worst because usually banks don't do the transactions over the weekend. So there's like 20 different things that go through on a Monday morning. But can you go a day without spending money? Can you go 2 days without spending money? Can you go 3 days without spending money? I think someone who is queuing up or preparing to be a homeowner can challenge themselves. Can I do that? Can I go It's that trying to shift that mindset of I don't need to buy something every day. I buy my groceries on one day, and then for the next 3 days, I'm pretty good. I don't have to go out and buy anything. And it's not a strong cash position to me. Is you're investing in other things. You're investing in your 401k at work, or maybe you have an IRA, or maybe you dabble a little bit with stocks. Having some other financial vehicles that you have, I think it, shows someone who's strong and ready to be a homeowner. On that weak side, and it's one that I'm seeing more and more often is at the end of the month, bank statements that are in the negative, right? That's a hard place to start from. Is that you know you begin the month with $10 and you end the month with negative 25. That person to me is not quite ready to jump into home ownership. So that the person says, I'll figure out the money. I'll figure out the cash. We call it chasing funds. I'll do it for my next few pay stubs. That doesn't usually work. We can't save pay to buy a home. It's just not an exercise a bank is good at, because you're so much faster than what a bank can do. They can't verify it fast enough. So plus the money they have for pay is usually you know earmarked for other things. Venmo exchanges. I see a lot of people who share money back and forth with friends and family. Although I love the spirit of that I'm willing to lend my sister, or I'm willing to lend my brother. I love that openness. I find usually that it's need, right? Everyone needs money, and so that's kind of a weak thing. Cash advances. Oh my gosh, I have a online bank that many people have, where I think as I look deeper into it, it's getting scarier and scarier, because they'll front you pay, give you cash advance on your pay. They charge you obviously a fee for it, and when their pay comes in, half of their paycheck goes to trying to repay money that they advanced themselves. So that to me is that's something that has to be rectified and kind of corrected and looked at, um, because advancing money when you're ready to go buy a home is probably not the right formula. Not reviewing bank statements. Every month, every day, I think people should be looking at their bank statements, looking at how much money they have. This is what I've got. This is what I can spend. I can't spend over this amount. So knowing where you are. ATM fees. So people who have withdraw money from ATM machines that they have to pay fees on. And usually keep in mind there's a double fee. Usually it's the machine charges you a fee, and then your bank charges you a fee. So it grows. It's not $3 anymore, it's $6. And that to me is someone that's not planning, right? If you need cash, then let's plan on where can we get that cash for free. So places like Sheets and Get Go, are my two big places where I go to get free money from the machines. Um, Cash assistance, so assistance to buy a home. PHFA, the Pennsylvania Housing Finance Agency, one of our good friends here in our state. It's a quasi-government agency, so it's not quite private, it's not quite government, somewhere in between. But their mission is home ownership and residence kind of programs. They help build senior living centers. They help build low and moderate income apartments, and they also have a division that helps people with home ownership. So trying to increase homeownership across the Keystone State. So PHFA has a program. They've got several programs, and they'll lend you 5% of the purchase price. So on that $150,000 home, they'll lend you $7,500. So that's half, basically half of what you need. They'll lend it to you over 10 years, and you don't have a monthly repayment. So as long as you live in the home for 10 years, then that money is forgiven. So if you stay there for 10 years, then you just got $7,500 for free. You can leave in 8 years or 6 years or 3 years. You're not forced to stay there, but you would have to give a portion of that money back, and that would be prorated based on the time you've spent in the property. So if you've been there for 3 years, you'd have to pay, whatever 7/10, whatever the 7 years left would be. Requires a little bit better credit score, so not 620 anymore, 660 and better for that to be an access to that. So as I said, 620 gets you in the door, but it gets you in the door, and more of that money responsibility, more of that cash responsibility falls on you. At 660, then you can kind of offload some of that responsibility for cash off to PHFA, and they will take care of it for you. So it's kind of a great thing. And if you can get to 620, I'm convinced you can get to 660. It's not that much further, but that's where they open it up. And it's available 12 months a year. So there's no blackout period for that. That's fantastic. That's something that you can plan on. You can plan on it. It's going to be available in April. It's going to be available in August. It's going to be available in October, which I think is so important. First Front Door is another matching program that we see, and it'll give up to 15,000. So clearly, in my mind, that's a lot more money. They'd give you up to 15,000. They want a little bit better credit score. That's 660 to 680. But it's a limited time offer. I mean, it opens up and then it's gone within a week. So it's pretty hard to pin that money down. And tap into that. So you have to be buying a home at the exact moment that it opens up, and you have to work through, whatever the participating bank's process is. But it is a pretty small window, to catch that money. So, but it's out there. There's some programs in Penn Hills. The city of Pittsburgh has a couple of different programs. Different banks or lenders have programs that maybe reduce or waive the closing costs based on income and assets and where you're buying. So there's some other programs that are out there, and there's probably a lot of programs that I'm not even familiar with. So these are the couple that I know and are pretty steady that we can count on. I like things that we can count on. So a couple of different loans out there, VA loans. So they're only for veterans. If you didn't serve, then it's not for you. And they'll do 100% financing, and the seller can pay all the closing costs. So Western Pennsylvania is a pretty high veteran population. If you're not a veteran, maybe you know a veteran, just make sure that you ask them, have they considered home ownership? Be a good friend, be a good steward. As you're learning, I want you to share your information that you learned with other people. So if you know someone's a veteran, ask them if they know about the VA loans, and have they ever thought about doing that. So another good loan program is the USDA rural housing. These are for more rural areas. They don't really work here in Homestead. Elizabeth, Charleroi, Fayette County, Westmoreland out there. This is a program that can work pretty good in those areas. They'll finance 100% plus costs. It's a pretty good deal. And credit scores around 660. But if you don't want to live out there, then this isn't really a loan program for you. Conventional loan, usually better credit. They can do a 3% down payment. Seller can help on a minimum down payment with about 3%. So when we talk about that 10%, on a lower down payment conventional loan, seller can pick up 3%. So you just have to worry about the remaining 7% of what you need. So it's a good program, one that we see from time to time. Most common loan program I see is FHA. Pretty much the entree into home ownership for many people, because it has a little bit modest credit score, 620. Remember, at 620, you're going to be handling more of the closing cost on you rather than shift it to PHFA or some other program. Subtle benefits: you can do 100% gift. So if you had no money and your Aunt Sally wanted to give you all the money, that can work. And the seller can pay 6%. So when we talk about that 10% estimate, if the seller picks up 6%, then you're only worrying about 4%. So if we could couple that with PHFA, if we could do an FHA, PHFA, like a sandwich, kind of stacking things on top of each other, the seller can pay 6%, PHFA can do 5%. You basically don't need very much, if anything, to get into home ownership. So if we can do the credit, then that really eliminates a lot of the cash part of it, right? So good credit will take care of of cash. If you have no money, with better credit, there's some ways that can be worked out. You're always going to need money. You're always going to need money to buy a home. Hand money, deposit money when you sign a sales agreement. You need a home inspection, that's 700. Appraisals, 700. So you need money. You need a couple $100,000 to get started. But we might even get some of that money back if you stacked it like that. So And they also say that they can do credit score with 580 with extenuating circumstances, and usually that extenuating circumstances that you have money. You have money in retirement funds, you have money in savings or CD, money somewhere else. So, and usually that's not the case. Usually, if you have a 580 credit score, you don't have any money, or else you wouldn't really have a 580 credit score. So that is yeah, so it says on paper they can do it. It's one of those things that it's like it's a unicorn. It's pretty rare to see anyone make that work. And oftentimes lenders will tell me, we do 580 now. I say, when's the last time you did one? And they can't remember the last time they ever did one. So it's kind of the white whale out there. Um, Once you buy a house, it's not just getting in, but you have to move in. You have to get a van, food. You might want professionals to move you in. You got to turn on utilities, do updates. You want to purchase, you want paint, you want rugs. So, and I want you to have money left over just in case, right? Because life will happen, car will break, the hot water tank, even though you had the home inspection, the hot water tank's going to go, the furnace is going to need to be cleaned, all those back end. So it's not only is it upfront cash heavy, but there's going to be some costs once you move in. So it's not just getting into the house, it's getting into the house and positioning yourself to be successful. That's what Mon Valley Initiative wants. We want successful homeowners because we don't want families to face foreclosure. We don't want families to struggle. We want to make sure that you're strong and ready to take on this responsibility. So, sometimes I work with people and they decide they don't want to buy a home. And my boss, she doesn't see that as a failure. She sees that as a victory, is that we help someone identify that maybe being a homeowner wasn't the best thing for them. And we're really okay with that. We'd like to see people be successful if they can with home ownership. How to create a winning plan. You got to start, right? You got to, anything you want to start, and you're here, great. You did number one. You started, so that's fantastic. Stay calm. Don't get all frantic. Don't try to do too many things. Plan your task. What am I going to do? I'm going to fix my credit. That's my task. Focus on one thing I'm going to do with my credit. So I know that my JP Morgan Chase card is too high. That's what I'm focusing on. I'm going to do my best to do everything I can to make that go down. And then once we do that, then we're going to move on to the next thing. Yep, I got this collection with Progressive Insurance. I'm going to take care of that. So, find a task, focus on it, and get it. Remove distractions. So, removing anything that gets in your way of that. Break your task into simple steps. Yeah, I'm going to send 50. I'm going to send 100. I'm going to do this. I'm going to do that. I'm going to watch this video. I'm going to talk to my friend who owns a house. I'm going to break those into little tangible steps and then stay consistent. That's the key that I'm working with this year is that every day, being consistent. I want to be a homeowner. You don't just do it once a month. You do it every day when you wake up. Stay consistent with that. One of the things I've always shared with people is, go find a house you've always loved. It might not be for sale, but it's a house you like and it's a house you fantasize that you want to live in. So go take a picture of it and put that picture on your bathroom mirror. So every day when you get up, every day, stay consistent. Every day you look at that picture and say, I'm going to be a homeowner. I want this little house. I'm going to do the things that get me closer to that today. So stay consistent and then take action without overthinking. It's not, if you remember, I said it's easy, right? It's simple steps done over and over that are going to get you to this goal that you have. That I'm a firm believer is a great and worthy goal to be a homeowner for your family, so you can have a dog without a landlord looking over your shoulder, independence, all the things that I believe in, owning just a little piece of this world, all those things I believe in. Don't overthink it. It just takes little steps at a time. And we have some questions. I see some questions in the bottom there. So here's some people sending some questions early, and I love that. So are there grants, et cetera, for homeowners? So I hope we addressed that for you. I hope I mentioned those couple. So there are grants available for people. Sometimes they're specific to locations, like Penn Hills. Penn Hills has a grant program. Last time I checked, sometimes they're like for the state, so they're all over the state of Pennsylvania. So some are specific to areas, some are specific to this state. So yes, there are grants out there, and I want you asking people, because Jonathan Weaver doesn't know everything. I want you to ask other people. Sometimes when you're going to open houses and I want you to go into open houses, pretend, look at other people's houses, practice, get them, talk to that realtor. Do they know of anything that's out there? Funding for no money down. Yeah, there is funding. We saw VA. If you happen to be a veteran, you can buy a house with no money. So there are programs. There are programs, and we talked about, on a PHFA, FHA, where seller pays some, PHFA pays some. That's out there. But if you remember, the key to that one is you got to have a little bit better credit. So yeah, there's funding available. It's easy, but your task is to get that credit score to that point where that opens up for you. At 620, that doesn't open up for you. We got to get in that 660 range. How does Allegheny County Housing Authority Homeownership Property Program work? Are there income requirements? Yeah, I'm more familiar. I do some work with Westmoreland County, which is kind of weird, but I do a lot of stuff with Westmoreland County Housing. I don't do a lot with Allegheny County Housing. I'd love to. I'd like to do more. But yeah, there's a Housing Choice Voucher Program, the Housing Choice Voucher Program, which they can help. So basically, in theory, through Housing Choice Voucher, the rent for the apartment's 1,000, and based on your income, you pay 500. Well, that means that the county's paying the other 500. Well, they can carry that into home ownership. Instead of paying a landlord 500 and 500, they can pay a mortgage company 500 and 500. So there are requirements. You got to be working more than 30 hours, I think, and you've got to have good credit, and you've kind of got to follow their system. There's more checks, there's more balances with that. But if you deal with Allegheny County, whether in McKeesport or McKees Rocks, reach out to them and ask them to send you some information. Kind of starts with them. They do require housing counseling. We can help you with that. But yeah, there are some, certainly there's always fine print with any program. But Allegheny, if you happen to get housing choice voucher, that's a great way to go about it. Down payment assistance. So yes, grants, closing costs. We got PHFA. We've got first front door if you happen to hit that window. We've got bank programs. Maybe it's not down payment specific, but it could be closing cost specific. So maybe you handle the down payment and they handle the closing cost side. So that's certainly a way to get in there. Looking to purchase home and closing costs and down payment. How to improve my credit? So hopefully we touched on that, right? Credit, we talked about get rid of the old, get some new, and do that. Low literacy, lower English level consideration for buyers. Yeah, so obviously, at risk, right? But people that don't speak English as a second language, people that have, yeah, that's someone that's at risk, right? At risk for scams and people taking advantage of you, and yeah, so that's important. So we do have translation services available. So if English isn't your first language, we do have access to get some interpreters to kind of bridge that gap. So yeah, that we've got there are systems in place to try to help people with that. Red flags to look for. We could spend hours thinking about red flags, and I don't know what that's specific to buying a house or specific to buying out loans. There's a lot of things. I always say protect yourself. Make sure you understand. You understand. Ask questions over and over until you have some understanding. Ask for it to be presented in different ways. And just trust your gut. Your trust your gut. It's usually a good sign that maybe when how do you avoid red flags? Well, deal with people right? Deal with your bank. Deal with banks in the area you've heard of. Deal with people deal off of referrals. That can help you avoid some of those red flags. Most of our local banks, the PNCs, the First Commonwealths, the Huntingtons, the dollar banks in the world, that they all do fine. I don't see any of them as trying to rip you off, right? I think that their intent is good for the most part. Still protect yourself, right? Protect yourself. Savings for closing. But what are expenses that are other expenses? A lot of expenses we don't know. Fixing a furnace, fixing a sewer pipe, pouring concrete. Dental work, those are all things that can hit. So we have to be prepared, not just to get you in the house, but to have some fallback money just to be be ready. Best steps to take, time's running by. Best steps takes to get started. Any step, right? The first step. You came here. That's a great step. Talk to friends and family. If you know someone that bought a house, talk to them. Do your Google research. Talk to realtors. Go to open houses. Those are all great steps. Self reflect. What's wrong? Do I need a better job? Do I need a stable job? Do I need credit? Do I need savings? Do all those things you can do all on your own. And then if you're getting to the part where you're like, hey, I want to be in 12 months, I'd like to have this done, and give us a call. We'll help you maybe refine, maybe laser focus, go from floodlight to a little bit more focused on what to do. We're going to stay in look down payment, closing costs. We talked about some of those home renovation assistance programs. There's some great home renovation programs out there, a little more complicated. I would not say that that is a typical first time home buyer kind of deal. There's programs that allow you to buy a house, get a contractor, and make those two things into one loan, which I think is better financially, other than getting a home loan and then getting a repair loan. Now you have two loan payments. But yeah, there's some programs that will do that, but they're more complicated, right? You need to have a home, you need to get a contractor to show up, to give you some bids, to provide insurance. They can be a little more difficult, but they are out there. And if you have something specific, we can maybe put you in some good directions. Other resources, low income people purchase and maintain a home. Yeah, it's difficult. When you're low income, it's difficult to buy a home because there's not much left, right? After food, after the payment, after kids, after car insurance, there's not much left. And that isn't leaving enough to maintain a home. And if you can't maintain a home, then you probably don't want to be a homeowner, right? That hurts to say, but if you're low income, there's not enough left. It's expensive to fix things. So, and unfortunately, when we're low income, then we're usually looking for lower sales price homes, which have sometimes deferred maintenance. So it's a tough little circle we get into. My wife and I would love to purchase a home someday. Good. I'd love for you to do that. But we're young. Well, young has nothing to do with it. And young people buy homes all the time. But you got to start. And we have little savings and not sure where to start. So good. So go back to best steps to take. Just talk to friends, talk to family, do research, go to open houses, talk to realtors. Just do a lot of talking. Don't say yes to anybody. Just do a lot of talking and do some self-reflection. What's the minimum income requirement to buy a house? So there is no minimum income. Anyone can buy a house. If you make $1,000 a month, you can buy a house. But there's a reality is that if you make $1,000 a month, that you can't buy food and you can't have a car payment and you can't have car insurance and it doesn't leave any money for groceries and you don't get to go on vacation. So there's no minimum. It's just the minimum is going to dictate what you can buy. So if you make $1,000 a month, then you have to find a home that's like $15,000. Well, you can't afford it. Nobody wants to live in a $15,000 house. So, there is no minimum, just to be clear. But what you make sets what you can buy, and that's the challenge, right? Is modest incomes going to lead to modest homes. And we saw an article not too long ago that it was different states in the country what it takes to for a family of four to buy a home. And in Pennsylvania, we were one of the lowest states. It was like $88,000. They were saying like $88,000 is what a family of four needs to buy a home in Pennsylvania. Now I know that's not, could probably do less than that for sure. But it's not too far off because if you're a one income household, it's a little more difficult to do it all, right? To buy food and groceries and have healthcare and all those things. So it can be, I get it. It's a challenge. It's getting harder and harder. All right, there's some questions here, and one says, "What's a kitty condo?" Well, kitty condos, if your child goes to college in Texas and Dallas, and you want to buy them a condo for them to live in for those 4 years that they're in college, a dad could do that, a mom could do that, right? So I'm not going to live there. My kid's going to live there, but I can finance it so my kid can live in there and take advantage of lower down payments that they would have. So that's what a kitty condo is. Collateral. Why is the home inspection completed after the sales agreement? Yeah, that's a great question. Yeah, that's technically how it happens. It's after you don't get the right to send an inspector into the property until you set an agreement to buy. So no seller, and that in my knowledge, I'm sure there's an exception, but no seller is going to let you do a home inspection before the agreement of sale. So you typically, when you sign a sales agreement, you usually have 14 days to send in your home inspector. Home inspector writes up a report, and based on that inspection, you can go back and ask the seller to make changes, repairs, update furnaces or roofs that are leaking. They can ask them to do that. Doesn't mean they have to, doesn't mean that they will, but you can ask. But if they don't, if they choose not to fix that leaky roof or fix that furnace, then you have the choice of not going forward, which in some cases that's really sad, but that's a great call, is to not move forward in some cases. If they're not willing to buy and you don't have the money to fix it, then maybe you don't want to buy that home. So, yeah, so it is definitely home inspection or sales agreement first, home inspection within a specified period of time, usually 10 to 14 days. And then you can go back and ask for repairs. They don't have to do it, but you can ask. And if they don't do it, then you can talk to your realtor about getting out and getting your hand money back. So, all right, that was a really good question there. So, what if you don't keep lines of credit flowing? Meaning, if we have a history of credit over 2 years, but we fully pay out credit off, will zero activity negatively impact our credit score? So, well, good on you. I'm happy that you're able to pay off your credit. I love that. To me, that means you're free of making the bank rich, and I love that. Um, yes, if you have no activity, then there's no positives going in every month, right? So that's kind of that tricky. I love what you're doing, right? I love that you're free of debt, but you can't get good credit if you're not making a credit payment. So, maybe for someone like you get a couple small credit cards. And what I recommend is you have a MasterCard, and you put your Roku on that as a monthly expenditure. And then you have a Chase card, and you put maybe you do have PlayStation, right? You have a monthly PlayStation fee. You put that on that MasterCard, or maybe you have a gym membership. Put that gym membership on a recurring charge to your credit card, and then when those bills come in, go ahead and make those payments, because those things you do pay, like gym memberships and um, Prime and Disney Channel, those things. When you pay those from your bank statement, you don't. That doesn't affect your credit, right? But maybe if you put it on a credit card and you pay off the balance every month, then you're not going to get any interest charges. So you continue to be great as far as a borrower, and do that. So yeah, I do think, unfortunately, to play the game, you got to have credit, and in order to get credit, you got to have credit out available. And I'm sure your credit score is probably pretty good, but once you pay stuff off, then there's no more good flowing in there. So maybe a strategy for you would be, if you have credit cards available, is maybe shift some small, simple recurring charges over to those, so that you can pay those off every month, and you would get your credit for being responsible and paying those on time. So that's another good question. So, Katie, it always goes by so fast.
It does, and
I'll
it's
do my
always
best
great
to rush, but I
information.
never
So
make it,
thank you for
never get to
that.
target. But